Welcome back to the Deep Dive. Our mission here is, as always, really simple. We take a dense stack of sources and we give you the absolute fast track to expertise.
And today we are really tearing into a fascinating story.
We are. We're talking about a company that, perfectly exemplifies what happens when an organization finds a winning structure and then just relentlessly for decades executes on a plan.
We're talking about Brown.Brown, Inc.
That's right. An American insurance brokerage firm that really engineered its own rise from what was a small regional Florida agency into a global titan. We've got a whole stack of resources here focused entirely on how this company got so big and, maybe more importantly, how it sustains it.
And that really is the core of it. The goal for you, our listener, is to come away from this with a deep understanding of the mechanisms, the financial pivots, and the incredibly aggressive acquisition strategy that turned a 1939 startup into a, nearly $5 billion enterprise today.
It's incredible. We're not just listing facts. We're trying to dissect the anatomy of their growth. Okay, so let's unpack this. When we say scale, we mean real global scale. Yes, they're headquartered in Daytona Beach, Florida, but they trade on the New York Stock Exchange. Ticker is BRO.
And they're a component of the S&P 500. This isn't some niche player. They are woven into the very fabric of the U.S. and, increasingly, the global economy.
The numbers really drive that home.
They do. To put it in context, we're looking at 2024 figures. A staggering $4.81 billion in annual revenue. They aren't just big, they're elite. They're currently ranked, number 7 among the world's 10 largest insurance brokers?
To go from a local agency to a top 10 global player, that's a masterclass in corporate strategy.
It is, and every masterpiece has foundational strokes.
So let's start there. Let's go right back to the beginning, the kind of origin story that you often see get glossed over with these giants. We have to rewind all the way back to 1939, Daytona Beach, Florida.
Yep, and it starts as a classic partnership. The company was originally named Brown & Owen.
Brown & Owen.
The foundation was built by J. Adrian Brown, who partnered up with his cousin, Charles Cobb Owen. And, like a lot of successful firms back then, they weren't trying to conquer the world in 1939.
No, of course not.
Their focus was completely local, building a solid customer base right there in Central Florida. It was all about being trustworthy, being responsive. They were laying the groundwork of regional trust.
But the ambition, or at least the seeds of it, were sown when the next generation stepped in. This is J. Adrian's son, J. Hyatt Brown. He joins the agency in 1959.
And this wasn't just, joining the family business. This was a genuine generational shift. It was aimed squarely at growth.
And it happened fast. By 1961, just 2 years later, he buys the company outright. He's the new CEO.
And that immediately kicks off a period of, modernization and pretty rapid expansion. You have to remember the timing here. He takes the reins when he's just 22 years old. He buys a company that's still very, very moldable. J. Hyatt Brown saw that the existing structure, while it was great for a local business, would never, ever support national ambitions. He knew he had to change the company's DNA, and he had the chance to do it early.
And that brings us to what is probably the most defining structural pivot in the company's entire history. The entrepreneurial leap they took in 1980. This move towards deep decentralization, which on its face seems almost counterintuitive for a company that wants to grow and have national control.
It is arguably the single most important strategic decision they ever made, period. In 1980, the firm adopts this formalized, aggressive, decentralized model.
And they were open about why, right? It wasn't some fuzzy cultural thing.
Not at all. They were explicit. The goal was to boost revenue and, critically, to boost profit margins. They didn't do it to make employees happy, though that might have been a side effect. They did it for the bottom line.
Okay, so let's dig into that, because conventional wisdom, especially for a scaling company, is usually centralization, standardization. You do that to maximize efficiency. So what advantages does extreme decentralization offer an insurance broker?
The advantage is speed. It's local knowledge. And it's accountability. In a decentralized model, you are pushing authority, you're pushing P&L responsibility and operational decision-making power down to the level that's closest to the client.
So the local office.
The local office. It means the headquarters in Daytona Beach, while they're setting the big financial guardrails and compliance standards, they are not micromanaging underwriting decisions in Seattle or Boston.
That immediately solves one of the biggest challenges for a broker, which is that insurance is, at its heart, a local business built on regional relationships, different state regulations, specific risks.
Exactly. Hurricane risk in Florida is not earthquake risk in California. So this model fosters a real, authentic entrepreneurial culture across the whole organization. When a local office leader knows they are 100% accountable for their own profit and loss statement, and their bonus is tied directly to their margin. They operate like a motivated owner.
Not a branch manager.
Not a branch manager. They have the incentive, and just as important, the agility, to respond instantly to whatever's happening in their local market.
I have to push back a little here, though. Doesn't that create chaos? Doesn't that level of autonomy lead to inconsistent risk underwriting or maybe brand dilution or even regulatory messes across 50 different states? Don't you risk the whole thing pulling in 50 different directions?
That is the critical tension, and the management of that tension is the real art of the Brown model. The home office provides the centralized stuff, the IT, the compliance oversight, the access to insurance markets, the capital, but they intentionally limit control over local sales and operations.
So how do they enforce standards?
They do it through highly disciplined financial reporting and a culture that, frankly, rewards performance mercilessly. If an office consistently underperforms, they address the leadership of that office directly. So the discipline of the balance sheet replaces the rigidity of a bureaucratic rulebook.
I see. And critically, this decentralized structure set the stage perfectly for their massive acquisition strategy later on.
Absolutely. 100%. Think about it from the perspective of a seller. You're the founder of a successful middle market brokerage. You've spent decades building local trust. The last thing you want is to be bought by some monolithic firm that's going to come in, wipe out your company's name, fire your team, and plug you into some rigid corporate P&L system.
But Brown could come to them with a totally different offer.
A completely different pitch. They could say, we'll buy you, we will inject capital, we'll plug you into our national resources, but you keep your name, you keep your local team, and you keep running your P&L with local authority.
That is a very attractive offer.
It's a game changer. Their structure dramatically reduces the risk of integration failure. They're buying teams, they're buying relationships, and they're buying cash flow, and they are built to integrate those things while preserving the very entrepreneurial energy that made that agency attractive in the first place.
They were structurally ready to be an acquisition engine long before they had the money to actually fuel it.
That's the key. So moving forward a bit, in 1983, they officially changed the name to Brown & Brown, Inc., to reflect this new national ambition, shedding that local Florida identity.
And this whole journey continues to be guided by the founding family. Even as it becomes this national entity, the succession plan keeps that legacy alive. In 2009, Hyatt Brown steps down as CEO.
But importantly, he stays on as chairman of the board. He's still providing that strategic oversight.
And he's succeeded by his son, Powell Brown, who is the president and CEO today. That's third-generation leadership, which is just extraordinary in an S&P 500 company of this size.
It's remarkable. And, while that family continuity provides a very stable long-term vision, which is so critical in the risk management business, it's worth noting the counterpoint.
Right, governance questions.
Yeah, it can raise questions about governance, especially from big institutional investors who, they tend to favor strictly independent boards. But in this case, their performance speaks for itself. The family vision has been incredibly effective. It's an active, profitable leadership principle for them.
Okay, so if the 1980 decentralization was the blueprint for how to operate, the 1993 move was the financial foundation that gave them this, almost unlimited runway for expansion.
This is the milestone. This is what turned a successful regional broker into a national consolidator.
So, 1993, what happened?
Two defining financial events that year. First, they merged with a company called Poe & Associates, which bolstered their core business. But second, and vastly more important, they went public. They listed on the New York Stock Exchange. Ticker, BRO.
Let's really elaborate on the importance of that IPO. Because going public, okay, it raises cash. But you're saying the real power here was in creating a new kind of currency.
Exactly. The cash is nice, but the game changer was the ability to use public stock as a currency for acquisitions. Before 1993, every deal they did meant burning through cash or taking on debt.
Which limits you. It puts a ceiling on how many deals you can do, how big they can be.
It constrains everything. But after 1993, the whole dynamic shifted. They could now issue shares. They could approach the owners of those successful middle market brokers and offer them highly liquid shares of BRO stock.
And for the sellers, that's a huge advantage over just a cash deal.
Two huge advantages. First, it's often a much more attractive tax-deferred exit strategy. And second, it ties their future wealth directly to the success of the bigger combined company. They weren't just cashing out, they were joining a growth engine and getting to participate in the upside.
So that transition from cash or debt to using equity, it just fundamentally changes the scale and the speed of the acquisitions you can pursue.
It becomes a self-perpetuating acquisition machine. High-performing stock lets you fund bigger deals. Those bigger deals drive more revenue and profit, which then reinforces the stock price.
Which lets you fund even bigger deals.
And that's what enabled what the sources call a deliberate expansion strategy, focused entirely on buying up successful middle-market insurance brokers across the country. They had the structure ready with decentralization, and now they had the financial weapon, the public stock, to execute at massive scale.
And the results, I mean, they really do speak for themselves. You just have to look at the financial trajectory. They hit $1 billion in annual revenue in 2012.
A huge benchmark. That puts you in the major leagues.
But the acceleration after that is what's truly stunning. It took them 73 years to get to the first billion.
Right, 1939 to 2012.
And then it took them only 9 more years to almost double that. And now by 2024, they're approaching $5 billion.
Yeah.
And in 2021, they joined the S&P 500.
Which is just a huge stamp of approval. It cements their status as a non-negotiable leader in the American economy. And S&P 500 inclusion isn't just a trophy. It guarantees demand for your stock from all the big index funds.
Let's just underscore the sheer scale with those 2024 numbers again. We're talking U.S. $4.81 billion in revenue, almost $1 billion in pure profit.
U.S. $993 million in net income.
And U.S. $17.6 billion in total assets. This massive operation relies on over 17,000 employees, most of whom are working with a high degree of local autonomy.
It's the ultimate proof point. That's the decentralized structure being leveraged by public capital.
Yeah.
I mean, to visualize it, the company is managing nearly 200 times its total equity from the year it went public. It's just a staggering compounding effect.
And even as they've become this global entity, it's interesting that they've stayed committed to their home base.
Right.
In 2021, they built a huge new headquarters in Daytona Beach, 11-story building right on the river.
That's a very visible statement of confidence. It's an assertion that even as they're doing billion-dollar deals in London and Dublin, the historical roots in Florida are still their cultural anchor. It's a way to ensure that corporate identity, which comes from that family legacy, stays intact even as they absorb thousands of new people around the world.
Okay, so we've covered the how and the why of their growth, the structure and the finance. Now we need to dive into what Brown & Brown actually sells and how their organization gives them a competitive edge. What is the core offering?
Well, their primary function is pretty straightforward, providing risk management solutions, insurance products, and services. But their real strength is the sheer breadth of their client base. They aren't just a niche player. They serve businesses of all sizes, government institutions, professional organizations, individuals, you name it.
They're trying to be the risk solution for almost everyone.
Pretty much. And their geographic scope has scaled to match that, all 50 states plus select international markets. But the real structural insight here, as the sources point out, is the duality of their business model. They operate through two major, very distinct business segments.
And this is where it gets a little more complex, but it's critical to understand this division.
It is. So you have segment one, which is the customer-facing retail brokerage. And then you have segment two, which is called Arrowhead Intermediaries. And these segments are structurally independent but strategically synergistic.
Okay, let's break down retail first. This is the classic insurance advisor role, right?
That's right. Retail focuses on offering property and casualty insurance, or P&C and employee benefits products. So P&C is everything from your standard business liability and workers' comp to homeowners and auto policies for wealthy individuals. Employee benefits is all the complex health, life, and retirement packages for companies.
And the customers here are businesses, public entities like schools or cities, and individuals. They're competing head-to-head for clients against every other broker in the market.
Exactly. This is their direct, high-touch, relationship-based revenue engine. It's all about being the trusted advisor to the end client. But now let's pivot to Arrowhead Intermediaries, because that is a very different beast.
Arrowhead is described as a purpose-built platform. So who's the customer here, if it's not the end policyholder?
Its audience is strictly professional. It serves the needs of insurance carriers, other brokers, and specialized customers worldwide. This is where Brown & Brown sits at the very center of the industry itself, acting as a crucial middleman for other players.
And Arrowhead itself is broken down into 3 divisions.
Yep. Programs, wholesale, and specialty.
So wait, they're not only selling insurance directly to businesses through their retail side,
Right.
but they're also providing the infrastructure and the access for the carriers and smaller brokers who are their direct competitors.
Now you're getting to the strategic tension. And yes, they absolutely are.
Okay, let's go through those three Arrowhead divisions. What does the programs division do?
The programs division is probably the most innovative. Brown will essentially set up a highly specialized, turnkey insurance product for an entire niche industry. Think of, say, creating a unique insurance program for all the pest control operators in 5 states, or professional liability for a national association of architects.
So they become the expert underwriter and administrator for that specific niche.
Precisely. They manage the entire program on behalf of a major insurance carrier. They handle the marketing, the specialized underwriting, the claims, the policy issuance, everything. They generate huge volumes of niche premiums and earn substantial fees, and it allows the big carrier to access a market segment without having to build that infrastructure themselves.
Which creates a very high barrier to entry for competitors.
Yeah.
And now let's look at wholesale. This is basically the excess and surplus, or E&S, market, right?
Yeah.
Why is this so important today?
Wholesale is non-negotiable for a top-tier broker now. The standard market is becoming more and more risk-averse, especially for things exposed to catastrophes like coastal properties. So when a retail broker has a really complex or high-risk client,
Like a building on the coast or a new type of liability risk.
exactly, they go to a wholesale broker. And Brown's wholesale division, through Arrowhead, act as that expert intermediary, connecting that tough risk to specialized carriers in the E&S market who are willing to take it on, usually for a higher premium.
And Arrowhead provides that access not just for Brown's own retail brokers, but for outside brokers too.
Correct. And then the third piece is the specialty divisions, which is for the most technical, complex risks. Think marine, aviation, high-level professional liability, stuff that requires deep expertise.
Okay, so let's circle back to that core strategic dilemma. Brown is structured to both compete fiercely for the end customer on the retail side and at the same time support and profit from the smaller brokers who are their direct competition through Arrowhead.
That sounds like a constant, difficult balancing act.
How do they manage that? How do they maintain trust when they're playing both sides of the market?
This is the operational masterpiece. Or maybe the tightrope walk. They have to maintain a very strong, demonstrable Chinese wall between the retail and Arrowhead segments. Arrowhead's value to other brokers is that it gives them market access and expertise without the fear that Brown's retail team is going to use that relationship to poach their clients.
If that trust breaks down, the whole Arrowhead revenue stream just collapses.
It's gone. And the decentralized structure actually helps them manage this conflict. By keeping the local retail teams hyper-focused on their own P&L, operating independently of Arrowhead's day-to-day operations, they reinforce that separation that's required for trust.
That's an incredibly potent model.
Massively. They capture revenue at multiple points in the insurance value chain. It gives them huge leverage with carriers and incredible market intelligence. And this dual-sided structure is the core fuel for their next most important driver, the acquisition engine.
Right. We've established that the 1993 IPO gave them the financial currency, and this dual business model gave them the strategic market presence. Now we have to look at the sheer volume and the strategy behind the deals. The sources call it an aggressive acquisition strategy designed not just for growth, but to fill specific capability gaps.
And that's the key. Growth by acquisition is standard in this industry, but Brown's strategy is just. It's distinguished by its volume, its targeting, and its ability to actually integrate these new firms without losing the talent.
So let's start with the domestic strategy. The sources highlight 3 pillars: employee benefits, digital transformation, and E&S. Starting with benefits, what was the play behind the 2018 acquisition of Hayes Companies?
Hayes, based in Minneapolis, was a major player in employee benefits. As healthcare costs and regulations get more complex, benefits consulting becomes this essential high-margin and really high-retention business.
It's sticky revenue. Clients don't switch benefits consultants easily.
Exactly. So acquiring Hayes dramatically increased Brown's expertise and reach in a vertical that provides that reliable, recurring revenue. It was a huge shot in the arm for their retail segment.
Okay, next pillar, digital. Insurance is no exception to the disruption. So in 2021, they buy CoverHound and Cyber Policy.
This was a move of necessity, not luxury. While the high-touch broker is still essential for complex risks, A lot of insurance is becoming transactional and automated, especially for small businesses and personal insurance.
You can buy it online in minutes.
Right. So CoverHound and Cyber Policy were digital platforms designed for exactly that. Brown& Brown wasn't just buying revenue, they were buying tech infrastructure and expertise. They knew that if they didn't have a robust digital channel, they'd lose that profitable small business segment to the new insurtech competitors.
That makes sense. And then back to the excess and surplus market. This seems to be a huge area of focus. Why were the 2023 acquisitions of Orchid Underwriters and cross-cover insurance services so critical?
This ties directly to what's happening with climate volatility and risk. The standard insurance market is pulling back capacity from high-risk zones, coastal properties, wildfire areas, so the E&S market is becoming strategically vital. Orchid and Crosscover were leaders in that space.
So by buying them, they weren't just expanding their wholesale division.
They were securing necessary access for their own retail customers who needed that hard-to-place coverage. E&S capacity is a non-negotiable strategic asset for any top-tier broker today.
And it seems like their appetite for good old-fashioned domestic firms is still there too. The 2024 acquisition of McNamara Company.
Right. That shows the original strategy is still foundational. It's a multi-pronged approach. They keep the small to mid-sized engine running while they're simultaneously hunting for these huge transformational deals.
And speaking of transformational, we have to talk about the massive 2025 deal, the acquisition of Accession Risk Management Group, which included their rival Risk Strategies. The numbers on this are just shocking.
They are. This was described as a nearly $10 billion deal for a rival broker. In this industry, a deal of that magnitude isn't about synergy. It's about consolidation. It's about market dominance.
So what were they getting for nearly $10 billion?
Well, Risk Strategies had excellent platforms in areas where Brown& Brown wanted to be deeper specific complex liability niches, professional services, high net worth clients. But the biggest thing, market share, consolidating the middle market broker services space. The goal wasn't just to add revenue, it was to eliminate a major national competitor and absorb their talent and their client relationships.
And that middle market companies, too big for small local brokers, but not big enough to demand a global giant? That's the sweet spot, right? Often the most profitable segment.
It is. This acquisition is a definitive statement. It says Brown& Brown intends to be the undisputed leader for that huge, lucrative segment of the American economy. It's a massive absorption of market share.
Okay, let's shift focus to their international expansion. It seems like they followed a more calculated, measured playbook there, but it still ended with a massive leap.
Global growth was essential to stay in that top 10. Their entry into the EU market was really initiated in 2021 with the acquisition of O'Leary Insurances, which was an Irish firm.
Why start in Ireland?
Ireland is a critical regulatory and geographic bridgehead into the broader European Union. It's a stable, English-speaking platform that's governed by EU rules. It allowed them to learn how to navigate the very complex and fragmented European regulatory environment before making a bigger, riskier move.
And calculated entry point.
Very. And the culmination of that strategy was the 2022 acquisition of Global Risk Partners, or GRP,
A UK-based firm.
a major UK-based insurance intermediary. This deal was truly transformative for their European strategy. The UK market is mature, robust, competitive. Buying GRP didn't just give them a book of business. It gave them a sophisticated platform, immediate scale in London, one of the world's major insurance hubs, and a network to expand into continental Europe.
It's the same playbook they use domestically. Buy a strong platform and plug it into the Brown& Brown financial engine and decentralized structure.
Exactly. The challenge now is applying that model, designed for Florida, across these highly distinct regulatory environments like the UK, Ireland, and maybe soon Germany or France. But the principle is the same. Acquire local expertise, keep local autonomy, and inject capital and resources from the center.
So while the structure and the finances are the powerful machinery here, the sustained success really has to rely on the software, the corporate identity, and the culture that ties it all together.
Absolutely. The sources consistently point to a culture defined by 4 key traits: integrity, innovation, superior capabilities, and discipline. These are the principles that have to govern those thousands of decentralized employees.
And how does that actually play out when you're constantly acquiring and integrating new firms?
Well, integrity and discipline are the guardrails, especially in a highly regulated industry like insurance. But the focus on innovation and superior capabilities is what allows those acquired agencies to keep their edge. They are encouraged to innovate locally, to find better niche solutions and better ways to serve their clients, rather than waiting for some rigid mandate from corporate.
And that focus on entrepreneurial energy seems to be reflected externally, too. The company has a great place to work certified status.
That's a really important certification, especially when talent retention is your single biggest risk after an acquisition. It suggests they're doing a good job with integration, that morale is high, and, critically, that turnover is low among the brokers, whose relationships are the real value of the business.
And the global standing is the ultimate scoreboard. Number 7 of the world's 10 largest insurance brokers for 2024.
Right. It confirms that their aggressive strategy isn't just making them bigger, it's generating durable market influence and financial performance that stacks up against their biggest competitors.
Finally, let's look at how they manage modern stakeholder expectations, beyond just financial reporting. They publish a global impact report every year.
And that signals their commitment to what is now basically mandatory for a global public company: transparency on ESG, environmental, social, and governance priorities. It's not enough to just deliver earnings anymore. You have to show you're a responsible corporate citizen.
The report covers their teammates, communities, the environment, and internal governance.
It serves multiple purposes. It shows compliance with modern standards, it manages reputational risk, and it provides a centralized story for this decentralized company, showing how local efforts tie into a global responsible mission. It's the final piece of that corporate identity puzzle.
Okay, so let's try to synthesize this whole journey. We've broken down Brown's evolution from a family agency in 1939 to a near $5 billion global giant. The success story is really a masterclass in execution, built on 3 pillars. First, that decentralized model from 1980, which created the culture and the capacity for integration.
Then the 1993 IPO, which provided the public capital, that stock currency, for acquisitions.
And third, the aggressive, targeted acquisition engine that just relentlessly pursued capability gaps, from digital and E&S at home to these massive platform plays like GRP in Europe and the $10 billion Accession deal.
They systematically moved from being a regional success story to a true market consolidator. The result is a highly profitable, top 10 global broker with incredible market intelligence from that dual business structure, retail and Arrowhead.
So what does this all mean for their future? We spent a lot of time on the complexity of that dual-sided model, retail competing for the end customer and Arrowhead supporting other brokers.
And that raises the critical strategic question that defines their current and future challenge. Brown built their empire on local autonomy and ruthless P&L discipline. But as they scale up, especially after integrating Accession, the inherent conflict in that dual structure competing with and needing to serve the same brokers becomes exponentially harder to manage.
That's the ultimate test of their culture then.
It absolutely is. The question is, can they maintain the cultural finesse required for true decentralization and successfully reconcile the interests of their retail and Arrowhead segments when they're operating at a $17 billion asset scale without losing the trust of the very independent brokers they rely on Arrowhead to serve?
Right.
As they consolidate more and more of the middle market, that tightrope walk between being an essential partner and being the dominant competitor, it only gets higher. And the slightest misstep could alienate a huge portion of the wholesale market they depend on. Integrating a massive firm like Accession will be the ultimate proving ground for whether that 1980 blueprint can handle 21st century global scale.
A truly fascinating tension that is going to define their next decade. Thank you for guiding us through this deep dive into the anatomy of a global insurance giant.
My pleasure. Thanks for diving in.